Hi everyone. In today's video, we are diving into one of the most common pricing mistakes small businesses make: confusing markup with margin. It's a simple mistake, but it can have a big impact on your profits. So, let's clear things up. First, let's break down what markup and margin actually mean. While they might sound similar, they mean different things when it comes to pricing. Markup is the percentage you add to the cost of a product to determine the selling price. It focuses on how much more than the cost you're charging your customers. Margin, on the other hand, is calculated by subtracting the cost from the selling price, then dividing by the selling price. It focuses on how much of the revenue is profit after accounting for the cost. Why does this matter? Let's walk through an example. Imagine you're an electrician, and the cost of materials, labor, and travel for a job is $500. You decide to apply a 40% markup to cover your overheads and make a profit. Here's how the math works out. Cost of job, $500. Markup, 40% of $500, so that is $200. Selling price is equal to cost plus markup. That is, $500 plus $200 equals $700. So, you charge the customer $700, and you make $200 in profit on the job. Now, here's where the mistake often happens. People think that a 40% markup means they are earning a 40% profit. But that's not true. In this case, the actual profit margin is only 28%. Because margin is calculated as the percentage of profit over the selling price, not the cost. With a $200 profit divided by a $700 selling price, you're only getting a 28% margin. This means for every dollar of revenue you make, you earn 28 cents in profit, not 40 cents. If you want to achieve a 40% margin, your profit must be 40% of the selling price. Let's do the math. The formula for calculating margin is selling price minus cost, then divided by selling price. In simpler terms, to find your selling price, you divide your cost by 1 minus the desired margin. So, if your cost is $500 and you want a 40% margin, the calculation looks like this. $500 divided by 1 minus 40%, or $500 divided by 0.6. That is roughly $833 in selling price to achieve a 40% margin. The difference between these two methods is $133 in profit, and that extra profit could be the difference between covering your overhead or falling short. As you can see, confusing markup with margin can result in underpricing your products or services. And that can eat into your profits, leaving you without enough to cover your costs. If math isn't your thing, don't worry. We've got a free pricing calculator that makes it easy to calculate the selling price quickly and accurately. Just head over to our website and download it now. Thanks for watching. Don't forget to like this video, subscribe to the channel, and hit the notification bell so you never miss our useful tips.